All right. Thank you, Julia. So I want to welcome everyone to the financial immunity community. This is Ghana's first webinar for 2021. And I want to welcome everybody who has joined us from all the 16 regions in Ghana. I'm glad to say that we have almost about 22 different industries in terms of the working class in the public and the private sectors joining us for this session. And we are live also on Facebook. I want to thank the country representatives for Ghana, Julia and Alfred, for putting this together. Now, basically, just as Julia initially mentioned, Financial Literacy Foundation Africa, or FLF Africa, is simply a financial education on profits organization that has interests in driving SDG 1 across 46 countries in Africa. And for last year, we launched a program called the Financial Literacy for Coronavirus Alleviation. This was one of our campaigns that was meant to help as many people as possible, particularly the African worker, on building financial immunity. So we did a number of trainings, physically in person and then online. This year, we are taking it a step further and we are raising a community in each of these 46 countries. So we are building groups of individuals who would make time to learn and to study and build upon their knowledge about the financial services universe, everything that has to do with finance, the capital markets, among others, that people can leverage on so that as they work for money, their money can equally work for them. So for this year, the first webinar, actually this is the second. We did the first one for the Europe and the UK region, where our mission in UK hosted us sometime last week. But for Africa, this is the first. And Ghana leads that pack. So today we are going to be going into understanding stock market trading. And it's basically an educational effort to get people to demystify usually what is associated with the capital market and how difficult or how complex it is for people to trade or even do business in. So basically, we are going to be learning about how the stock market works and how anybody can leverage on this market. So that is what we are going to do. Now, if you look at this slide as I begin, you will notice, I picked this from a friend, you will notice that there is somewhat a pseudo competition between the rich and the poor. And the narrative is that if you give a rich man $1,000 or any currency at all, and you ask them to do something with it and bring it back after some time, they are going to be returning not just with $1,000, but with something more than that. It looks like it's reminiscing the parable that the parable Jesus told about the talents. Then the one on the right is talking about supposedly a poor man, and then you give him the same amount of money, but he returns with something that is consumable. And so the rich usually would invest their money inadvertently. That's basically what this is saying. And one of the ways you can get into the league of the rich and put your money to work for you is in the stock markets. And so that is one of the things we are going to be learning. As much as we can, we are raising a community that will live in the group of people that will be in the queue of the left, which for this purpose is the rich. Now, to really understand the stock markets and how trading is done and all that happens there, you have to understand financial markets, because the financial market is a superstructure market that holds what we call the capital markets and the money markets. And the stock market sits in the capital markets. So the universe market in financial services, we call it financial markets. And under financial markets, we have the capital and the money markets. In simple terms, very simple terms, the capital market is a long-term market and the money market is the short-term market. So as we are dealing with stock, understanding stock market trading today, invariably, we are going into learning about the capital markets. Now, there are two main things even under the capital markets in the long-term market. Some of the instruments that trade in the long-term market, we call the capital market. Some of them are what we call debt instruments, and others are called equity instruments. And so today we are looking at stocks, which is under the equity side. So if you look at this universe superstructure we have shared, you will see financial markets sitting at the top, and then you will see capital markets on the left, and then under capital markets, you will see equity. Today, under our financial immunity community, we are looking specifically at equity. So we are looking at one instrument under the capital markets, which is one market in the financial services market. And that particular instrument you are looking at is called the stock market. So we want to look at the stock market, and the things that trade in the stock market are called stocks. So to break it down further and to demystify this thing about stocks, first and foremost, when you say stock market, you can see it is a combination of two words. There is stock and then there is market. Let me start with the most complex because market is quite simple. But when you say a stock, it's simply a part, a portion. Sometimes you will hear shares, sometimes you will hear equity, sometimes you will hear stock. Either of these things represent the same instrument. I mean, literally. And so when we say stock, as we are dealing with stock market, your stock is your portion of a particular investment. But with respect to stock markets, when we say your stock, it is the portion you have of a company that is going public to invite additional investors who would have ownership in that enterprise. So basically, a stock becomes your share in terms of the part that you own in any public enterprise. And so that is stock when we talk about stock market. And I want to break it down further again. If you look at this slide, you will see on the right side something like a cake, and it is being divided into portions. The little part that has been taken out is the portion that individual who would want to enjoy a part of the cake is taken. And we assume that round cake or pie as ownership in, say, an enterprise. The moment you take a portion, which is your share, which is your own, it becomes just like we are saying, your stock. And that is how we call ownership in public companies that are either listed or unlisted. Sometimes if it's listed, it means it's in a regulated market. And so we call them listed stocks or listed equity. And the market that regulates this ownership structure in public companies is the stock market. And when it is also an ownership in a company that is not listed on a regulated market like the stock market, maybe in an over-the-counter or irregular market, that one too is a stock, just that it may not be a listed stock. When it is listed, it means it's on the regulated market. So at least for now, this explains what we mean by equity shares or stock. The next thing you have to now put together is the market that accompanies the stock. So we say stock market. Now, market, just nothing very complex. Market, just like any market, I mean, just the same way market means is what we are talking about. Just like you go to Makola Market or you go to Accra Mall or any market. And usually, when we are talking about market in its literal term, you see that when you enter a market, there are buyers and there are sellers. There are people who are going there to buy and there are people who are going there to sell. In the stock market too, it is the same. There are people who are there to make purchases and there are people who are there to make offer to sell off whatever they own. The difference only with stock market is that it is a regulated and a very formally structured setting. And so basically, the stock market is the place where stocks are traded. And so you will see investors who are there either to buy or to sell, basically. And that is the stock market. Now, because I said the market is a regulated piece, one thing you must understand is that that same market has a structure. It works with a structure. And the first thing you must know is that it has a regulator. So there is somebody who supervises the rules and the operations and the working ways of that market to make sure that things are done in a complied manner with rules that are passed. And so the stock market is regulated by what we call the Securities and Exchange Commission. And for many countries, it is the same. To the stock market structure. And I said that first and foremost, it is regulated. The regulator, in many instances, is the Securities and Exchange Commission. I mean, for the case of Ghana, since you are doing this for Ghana, the Securities and Exchange Commission is a regulator. And the market is structured such that companies who now want to come to that market to give people the opportunity to make purchases into their shares and have ownership, they go through what we call the initial public offering. That is the first point. So companies that want to get onto the stock market, they go through processes. And when they have passed the processes required by the market, they get into what we call IPOs, or initial public offering, where people are given the chance to make purchases into the company. So it is at that time, which we call the primary time, where anybody can look at the price per share and then look at the minimum number of shares you have to buy. And when they buy, they become owners in that enterprise that is getting listed on the market. Now, I must say that the organization that we want people to own and the investor who is now coming to buy and leverage on that opportunity to own, they are all investors in a way. And even though they are trading on the market is such that that individual who wants to buy and that individual who wants to take investment from people who are buying have somebody who ensures that transaction of buying and selling is done. And that person is licensed by the regulator. And so that person is called a broker. And so the broker is a member of the exchange, and he is the one who executes the decision of an investor to either buy or sell. So unlike an ordinary market, you will just go and then you buy or you sell. But in the stock exchange, you make purchases or you make sales through a licensed broker or a licensed dealing member. And that is how that market works. So if you want to buy, you use your broker. If you want to sell, you use your broker. And if you are buying from the very primary setting, when an organization makes it possible for people to buy, we call it the primary market. And when maybe after the initial public offer is over, you've already bought the shares, you own it already, you want to sell, that one we call it the secondary market. I think I will explain. But at this level, we are just showing you the structure of the markets. We've talked about the stock markets, the market and the stocks, what they mean, and then the market itself and the structure that governs the market. Now, this is just a template for you to appreciate what happens. So you will see the regulator sitting at the top, and then you will see the company that wants to come to the stock exchange to make their shares available. That company walks into a market. An example may be the Ghana Stock Exchange or the New York Stock Exchange. And because it's their first time coming onto the market to issue their shares, which I said is IPO, that transaction, we call it, it is a transaction in the primary market because that will be the first time. And the market that they list to do that transaction where people can buy or sell becomes that stock exchange for the country in which the transaction is being executed. And then the people who sit in between the buyers and the sellers, they are called the brokers, and they are they are members of the exchange or the market. And then you and me who may want to buy or who may want to own some portion, we will go there as investors and we'll make a purchase or we'll make a sale. So that is the next level in terms of structure. To make it even more simpler, we break it down with this kind of flow chart. So company X is looking for money to come to their business. So they are looking for investors, and they go to the market and they look for the opportunity to list on the market. And in doing so, they get investors who will put their money into the stocks by buying them, and then money comes into the organization. Now, when that happens, the one who made that purchase into the organization, which is the investor, um, two things happen to you. The moment you buy that stock, two things happen to you. The first thing is that you have the opportunity to earn into the profits that that company makes. Why? Because now you are one of the owners. And so if the company makes profits or losses at the end of the year, you are an owner. And so it applies to you as well. And we call the opportunity to cash into the profit dividends, and the opportunity to cash into the price changes, meaning you bought a share at 1 cedi and the next day you went to check the price on the market and it has gone to 2 cedis. That price change, we call it capital gain. And so you barely make two earnings. One is you earn on the profits of the organization if it's declared so, which we call dividends. And then you earn on the price changes on the stock you bought, which is the capital gain. Having said that though, because the stock can equally fall the same way it rises above the price you bought it. When it rises above the price you bought it, that is what we call the capital gain. When the inverse happens, when the price falls below the price you bought it, we call it capital loss. And so this is how the whole market transitions and works. And there are buyers, there are sellers, and the market is regulated, and investors go to the market every now and then to make purchases. Now, to be able to trade on the markets, in addition to what we have shared, there are maybe say 1,001 terms you need to know. Just like if anybody wants to become a medical doctor, there are specific terms you need to know, working terms. I must say that same on the stock exchange and trading on the market, there are a number of things you have to understand. Just that for the purposes of this basic introductory session, we are going to share the must-knows. And one of them is what we call buy, simply just as you buy anything. And the other is called sell, simply just as you sell anything. So when you are buying, you are basically making a request to buy ownership into a listed stock. And when you are selling, you are basically getting rid of whatever you bought at a particular time and you want to sell out and go. As simple as that. So whenever you see buy or sell, it means buy, you want to make a purchase, and sell, you want to dispose of whatever ownership you have on the market. And remember, I said it goes through the broker who will execute that for you. Then there is bid and there is ask. Bid and ask. Bid is simply, I want to buy this particular number of shares in this organization. When you bid, you are simply making mention of the price you are willing to pay for that stock you want to buy. And when you ask, it is the inverse from the one who is selling it. So somebody has bought it already, he's selling. Somebody is now coming in to buy. The one who is now coming in to buy makes a bid. And the one who holds it already and is willing to sell makes an ask. And the difference between these two, whenever they meet, a purchase is done, or a sale is done, or a transaction is executed. But the differences between the bid and the ask, we call the spread. That is the difference between what you, the one who wants to buy, is quoting in terms of the price you want to buy, and what the one who owns and wants to sell is also quoting and wants to sell it at. The difference between the two is what we call the spread. Now, three more terms and you are good to go. The first is bull market, the second is bear market, and then I'll look at the limit order among other things, and then the buy, hold, and sell. Now, when we say the market is bullish or the market is bearish, it is a very simple thing, nothing complex. Breaking it down to mean bullish simply means that the market has entered a period where almost every price is going up above the original price, which was offered for sale. And when the market is experiencing a downturn, almost every price is tumbling and falling. We call it the bearish market. And so bullish simply means I mean, if we were dealing with macroeconomics, we would say inflation when prices are going up. On the stock market, when prices are rising fast and at a certain pace consistently, we call it the market being bullish. And then when it is falling equally, we call it the market being bearish. So when you hear this term, the market is bullish or the market is bearish, or we are we are in a bull market, we are in a bear market, or bear season, bull season, it gives you an idea of what is happening on the stock market. Now, I talked about buy, I talked about sell. This is initial, but there can be times where you don't want to buy or sell, you hold. And so when you hear hold, it is when you are deciding not to buy, particularly not to sell, because then you are not offering it to be made available to sell. So you hold it instead of making it available to sell. When you think the price that is being offered as bid is not favorable to you, and maybe the spread is too high and it doesn't favor you, you hold. You are not supposed to sell. That is that action. Then the last item is order. In the market, there are a number of orders. You when I want to buy and I'm asking my broker to make a purchase for me, sometimes with a certain understanding, like we are learning, you may have a certain appreciation of what you want to do. And so maybe you think that the market is going to do well, or maybe you think the market is not going to do well. So assuming you want to sell, as an example, and you give your broker a limit that the price is now maybe $1, but don't sell it below 80 cents. Then you have given a limit for whatever instruction that you want to go about, either to sell or to buy. And so when there is a limit, when there is a definite mark below which we shouldn't buy or sell, that is what we call the limit order. So at least in this regulated market and industry that looks weird and complex, you now understand stock. You now understand the market. You understand the structure of the market and some basic terms that runs that market. Now, for the purposes of our financial immunity community, we are going to be building you up to a point where you have your own appreciation. And when you are dealing with a broker, or when you are dealing with any international market where you can transact your own purchases, you have a certain basic understanding of stocks. Now, this slide is talking about the 5 essentials that everybody who is interested in investing in any stock market globally must appreciate. You must appreciate it before you make any purchase of any stock, either on the primary market or on the secondary market. Remember, I spoke about the primary and the secondary. I said primary is the initial public offering stage. Secondary is post that, when the initial public offer is over, you own your shares already and you want to buy or sell. But I'm saying that at any time in either of these instances, when you want to make a purchase, when you want to buy, when you want to make a bid for a particular stock, these 5 things, if you don't know anything at all, you should at least understand and appreciate them. So when you get into a conversation with your licensed broker, you'll be able to be on the same page with that party. Number 1 is that anytime you want to make a purchase of any shares, the share is not just something that sits idle. The share is an ownership in an organization. And so you should be interested in knowing about the company you want to buy into. So you research fully. You got to know what they do. You have to know where they do it, and you have to know how they do what they do. Understand that organization inside out so you can have an appreciation of why you want to buy that stock. The next thing is to look for the company's price to earnings ratio. And basically, we are looking at the current share relative to its per share earnings. So every stock or every share has a particular data in terms of what each share is able to give you in terms of returns. And usually, if you ask before you buy, they will show you the price to earnings ratio, and it gives you an idea so that you are able to tell the earning abilities of each stock, and you can compare with others so that you can tell which one is doing well, and it guides you to in your interaction with your broker or your licensed advisor, you can know what to do. The next thing is what we call the company's beta. It's another thing you must know, the company's beta, and it's simply looking at the risk. The risk. Remember, in investment, risk and returns are bedfellows. The higher the risk, the higher the return. The inverse is true. The lower the risk, the lower the return. And so you can't say you want to get into the stock market particularly because stock market is capital market. If you remember, we said financial markets have capital markets and money markets. Now, because capital markets are associated with some level of risk because of their volatility. Volatility simply means their prices can change up and down, go up or go down, because you are dealing with companies that can make profits or losses. And those things, and among others, can affect them. And because it's also on the market, people are buying, people are selling. And in basic economics, wherever there is buying and selling, you know, an equilibrium must be established. And that equilibrium will either tell if the price will go up or down. So if many people are buying, it means there is a high demand on the product. If there is little supply for sale, then you notice that the price will go up. If so many people are willing to sell, whatever product it is, and there are a few people who want to buy, you notice that supply will exceed demand for the product, and so the price will come down. Now, in a market like that, you have to take a close look at your company's beta, and that tells you the risk. And the risk here will mean the rate at which it is likely for you to make some losses on that particular stock. The next thing you need to know is dividend. And before you buy any stock, you should be able to ask about the dividend history on the stock in the capital market. Every stock you purchase has a dividend history, and you should be interested in the dividend history, and even sometimes go a step further to ask about the dividend policy. So the dividend history will tell you how dividends have been and been paid over the period. The policy will tell you how the company manages the sharing of profits at the end of every year when profit is declared or otherwise, based on a policy. Because some companies, their dividend policies are that if you don't get a certain margin, you will reinvest it into the organization. If we get beyond a certain margin, we will share it as earnings on the stock. And so it's another thing you need to know. Then lastly, in terms of the 5 things you must know, you must look for very simple clues from the market as to how price for that stock has moved over the period. So you can check for a week, you can check for a month, you can check for a year, as far back even as 3 years, and look at the price movement. How has the price fared? You are saying the stock is trading at this price, but what has been the price movement up or down over a period? And it guides you to know the direction of the stock. So, ladies and gentlemen, at least these 5 things, you should be able to appreciate them as you get interested in the stock market. And when you do these things, you can trade. For those in Ghana, if you want to trade, you look for a brokerage company, which would be regulated by the Securities and Exchange Commission and would have a brokerage license and will have licensed brokers. You go there, you open an account. In Ghana, there's what we call the CSD account, and the CSD account is just like a bank account, but in this sense, it's a stocks account. It's not physical, it's digital. So when you have the CSD account, you open your brokerage account, then you can engage with your broker with some level of knowledge, and you'll be able to be guided on your stock selection. And then you decide for every stock, the number of shares you're able to buy. Advisedly, maybe 100 minimum, and then times the price per share you are able to buy. And when you do, you choose your order. Remember, I said there are orders. Limit order is what I explained. So maybe the price is now 1 cedi or $1 per share. I am buying 100. The order limit you put there is to say, please don't buy below this or above this. So you can decide to either make it an open order where you don't give limits, or you give a limit order and say, when the price is below this, please don't buy. Or when the price is above this, please don't buy. If you do this, you become a stock investor. And the clue here is to always be looking out to buy when the price is low and to sell when the price is high. You buy when the price is low and you sell when the price is high. Very big clue. Many people sell when the price is just falling on the downside. So look at the markings, look at the arrows. Many people, they hear, oh, I bought this stock and it is falling. Because they heard it is falling, maybe from 10 cedis to maybe 1 cedi. That is the time they are going to sell. No, because the thing is falling already, what it should tell you is that there are a number of people who are selling out. And so probably there is excess supply against demand. And so if you want to add your supply to it, you'll be shortchanging yourself. Rather, you buy at that time. So you notice that the share prices are falling. You buy because at that time, everybody is selling. So you buy when everybody is selling and you sell when everybody is buying. And that becomes a clue that guides you. And you don't put your eggs in just one basket. So this is a portfolio we pulled from one of the greatest investors in the world, Warren Buffett, who is on the league of the world's richest just by virtue of investing. And this is his portfolio. That is just a clue to tell you that you don't go and buy just one stock on one market and say you are okay. No, don't put your eggs in one basket. You buy a number of stock in a number of companies in a number of industries, and you do it consistently over a long term, and you make the return or the best out of the dividends and maybe the capital gains. And that is how you build a billionaire or you build a rich man. And if you remember the first cartoon I shared on the slide, when you are given $1,000, if you put it into good use in investing, you come back with 10,000. And if you rather don't do that, you want to be poor, then when we give you something, you spend it on anything that is consumable. Now, ladies and gentlemen, as we end, these are the tips that can help you do well on the markets. So you must appreciate the finance, you must have a good financial plan for yourself, and you must keep a check on your emotions. Remember, you don't just sell because you saw the market going down, or you don't just buy because you saw the prices going up. No. And then you must have a broad portfolio. Example is a Warren Buffett portfolio I shared. Portfolio simply means multiple shares. So you buy here, you buy there, you build a portfolio so that when one is down, there's another in your bucket that is doing well. So you buy a mix of a number and then you monitor. You don't go and sleep. You monitor. When you make a purchase, you monitor, you listen to the news. Now, with this understanding, you'll be able to understand what they mean by a bullish, bearish. You'll be able to understand what they mean by price to earnings ratio and basic things that don't intimidate you. So you monitor and just check what the price is from how much you bought it. It gives you an idea all the time, and you're able to monitor. And when you do, if you can change your investment mentality from consumption, I always want to eat the money, I always want to spend, I always want to sell out, to a long-term mentality where you are building your wealth over time, then you are ready to do well. Lastly, this is just an example of a trading platform, a number of trading platforms globally, which gives you access to make decisions as to what stock you want to buy. So you go to platforms, and this is one platform I personally use, and you're able to trade globally. So if you look at the left side, you will see a number of what we call indices. So these are different markets globally, and they tell you how each of the indices are doing. So here, there's one example of a transaction we did in Germany. So these are some of the stocks. Another in France. These are some of the stocks. Another in the United States. These are some of the stocks. Of course, you see Apple, you see Game, you see Amazon, Microsoft, and things like that. Facebook here. So instead of having a Facebook account, you can be having a Facebook share. Instead of having an iPhone, you can have an iPhone share. And that is a way to build a certain wealth for yourself. You can go to the stock exchange, Ghana Stock Exchange, and equally get advice and make a number of purchases. So for example, this industry partner, which is Enterprise, is listed on the exchange. So you don't just buy a product from them, you buy ownership into them. So you are not just a customer, you are one of the owners, with guidance, with advice, and you're able to do well. And there's an example of some stocks in Malawi. In our next immunity session, we'll be taking into real life markets for those who would be interested in testing their hands on a buy or sell and things like that. So you know what to do. But this is how the dashboards look like. Now, what must you do? What must you do? Your mentality is one of the critical things that must change as I end, so we can open the platform for questions and answers. And one critical thing that will help anybody who is listening to me is what we are launching for the people in our community. And we are hitting 1,000 of these community members with what we call the Count Your Pennies Challenge. Last year, during our Financial Immunity 2.1 community webinars, one of the critical things we shared about financial immunity was counting your pennies. And usually people think you need so much money to even buy stocks or to invest or to buy a pensions account or an insurance account or whatever, but you don't. Very little amounts that you put aside can take you very far if you become consistent and disciplined. And we have launched a program called the CYP Challenge, the Count Your Penny Challenge. And simply all we are saying is that we are giving people the chance to take into action their decision to save and put money aside for their future. So we'll give you branded boxes, or you can even buy your own box. We'll give you a form you commit to be contributing a certain amount into your own box. And there are 3 different levels. There's regular. For the regular people, any amount from 1 CD to 50 CDs, you do it daily in that box that is locked up. So you keep it with you, but you commit to put in 50 CDs daily. It's over 10 months. And when you put it in minimum from 1 CD to, for the regular, 1 CD to 50 CDs, you put that amount there. It can be 1 CD, can be 50, can be whatever. But when you are in regular, you don't go beyond 50 a day. So from 1 CD to 50, whichever amount, you do that daily. If you are in stretch, you are stretching yourself to put any amount above 50 CDs up to 100 CDs. You do that weekly. You don't do that daily. So every week, maybe you put 100 CDs, a 51 CDs, a 60 CDs, a 70 CDs into that box that is locked. And if you are premium, you put a minimum of 101 up to 200. But that's when you do it bi-weekly. So every 2 weeks, you are putting 200, 150, whatever amount that is equal to 200 or not less than 100 CDs into that account. So you're either a premium challenger, a stretch challenger, or a regular challenger. You onboard, we give you a form, you commit to it, we give you a financial literacy consultant who will be checking on you, and we give you the box that you make a purchase of. It's with you, it's locked. You can't do anything with it unless you destroy it. And when the duration is over, you can be guided. You open it and then you decide what you want to do. Thankfully, because we have partners, there are forms that we call assessment forms that will guide you as you do the challenge, and you'll be able to tell by the time your challenge duration is due how much you are able to raise and where you put it. And it is so great that you will be able to raise in the 10 months. Some can raise 10,000, some can raise 50,000, some can raise 4,000, some can raise 3,000, depending on which category you choose. And these are monies you would have spent anyway, but you count your penny in this challenge, and you turn a penny into $1 million tomorrow. And when it is the challenge time is due, we open it, we record the session of opening, and the ones who were disciplined and did what they did, we commit our partners to give them money vouchers that will be backing up to whatever investment or whatever product they want to buy, and they sign up to that so that they build immunity. The goal is that by the time you are done, you should have raised not less than 6 months of your regular income, stack up somewhere that you can use to do anything that will give you some level of security. And when you do, you will be guided to become successful at what you do. For those of you who just joined and you want to get maybe a professional certification for also attending this session, you can also equally get this certificate when you request on the platform you find yourself, and the team, the country team, Ghana team, will be able to help you out of that. So this is one of the communities we are building, and our target between now and October is to raise 1,000 people in Ghana, middle class African workers, Ghanaian workers, who would want to build some level of immunity and dedicate themselves to putting as low as 1 CD all the way up to 200 CDs, either daily, either weekly or bi-weekly, into a locked account, a locked box, where a financial literacy consultant will discipline you to make sure you do what you say you will do, and to give you the opportunity to build some immunity for yourself. And thankfully, as we have started the immunity challenge, we are able to now get deeper into stocks, understanding stocks, get deeper into understanding mutual funds, get deeper into understanding bonds, get deeper into understanding fixed deposit account, whatever it takes, pension accounts, personal pension product, insurance product, life or general, any kind of thing that borders on banking, pensions, insurance, investment. We are going to be educating you so that you would understand it in a very simple term and leverage on it going along, so that we can end extreme poverty and raise young people, about 2 million across the 46 countries, who can be financially well and will be able to take their own financial destiny into their hands. This is the end of this initial session on understanding stock trading, and also an explanation and a launch into the challenge, count your pennies, that as many people will be interested, will be guided to take advantage of. And then with our partners that came on board, you can have a pensions account with as low as 20 CDs, 50 CDs, and you build your own personal pension account in addition to maybe your tier 2 or your tier 3, so that all rounded in terms of your banking, pensions, insurance, investment knowledge, you'll be all-rounded and you will leverage the financial services to your advantage, and you will not become a wage slave. That you don't always have to show up in the office before you can earn something. You don't always have to struggle and be running the rat race. That when your salary delays even for 2 weeks, you are hot. There's nothing you can do. That when your employer tells you that I can't employ you again, there's nothing you can do. That race must be cut off so that you will work because you want to, not because you have to, and you will hold your own financial destiny, and we would raise the whole continent out of the quagmire of poverty that determines how people live and how people behave and how people do the things they do without their permission. So, ladies and gentlemen, welcome to the financial immunity community, where we are doing our best to raise 8 out of every 10 Africans the opportunity to become financially independent. Thank you, and I'll end here so that we can open the floor for any question. At this stage, you can unmute yourself and ask your question if you raise your hand, and we will be able to sort you all out. Thank you very much, and God bless you. Julia, over to you.
Bless you too.
Okay, thank you very much, Doctor, for this insightful presentation. So we would pick some questions. If you have some questions, you can raise up your hand, we'll call you, but already I think we have some questions in the chat. So I would go through the chat and pick those questions. So Emmanuel Kweku Anan is asking, which companies will you recommend us to buy stocks from?
Well, let me start by saying that we are making sure that you practicalize some of the things we just learned. Remember, I said that in the market, you deal with a broker. And so first and foremost, you have to engage, visit a brokerage company, and if it's a Ghanaian market, begin to understand what the market is about with some of the things we shared. Some companies, if you, for example, go to the stock market and the Ghana Stock Exchange website, you can see all the companies that are listed. Those that come to you as you want to own shares in, take some time and research about what they do. They are ordinary companies, you know. And when you do those things and you are armed with these 5 must-knows, visit a brokerage company and you can be guided with the questions we have guided you to know. So you ask them specifically, what is their price to earnings ratio? What is their stock price history? What is the price movement like? You apply these things so that you can get real answers, and don't sit down and ask anybody, so what must I buy? When you do that, you mortgage your financial future to somebody's suggestions. But first and foremost, you have to appreciate it for yourself. So when you are engaging people, you engage them with a certain understanding. So I would say that subject yourself to these things we shared. And when you do, you would be able to even now tell your broker what you want to buy. And when you do that, you don't need to even go and ask anybody and say, somebody asked me to buy A, B, or C. Thank you.
Please, Emmanuel again is asking the name of the trading platform you shared with us.
In order not to expose people prematurely to that platform, since we haven't gotten there, I won't share it for the time being, because this was just the basic introduction. So I won't share it until we do the next financial immunity community, where we would have mastered the next level of trading understanding, and we can share a number of platforms globally that you can learn from.
Okay, what's the minimum amount you will suggest for someone to buy stock?
Again,
Different program. Zoom meeting.
Somebody is talking. Mute yourself, please. Mute. Mute. And this will be taken out if he doesn't. But Julia, to answer your question, you see, our platforms are very practical in nature, and we don't want to let people live in the realm of what must I do, what must I buy. Those things are not things that will help you to become a matured investor. So to ask about how many number of shares and to be told that this number of shares would be very ill-advised. But what you must do anytime you understand a stock and you want to buy with your broker is to always know the price per share. Always know the price per share of the stock you want to buy. After you've engaged your broker and you understand all the background information about the organization and the share. Then when you know the price, ask for the minimum number of shares you can buy. So always know the price per share. Ask for the minimum number you can buy. Usually it's a minimum of 100. And when you multiply the price by the minimum number of shares and it's something you can afford, then you buy. But when you multiply and it's something you cannot afford, then you mobilize to do. But ideally, if it's within your means, if you can buy more, because the more you buy, the more you own. So don't just say, how many must I buy? But always inquire about the minimum number you can buy and the price per share. And based on the money you have available to keep for a long time, you can now, together with your licensed advisor, execute whatever you want to buy.
Richmond, Evans would want to know what is the difference between Forex trading and stock markets?
Now, Forex, just as the name, is foreign exchange. So we are trading in foreign currency. Stock market is, as I explained, equities, stocks, listed companies.
Okay, thank you. Mohammed Abubakar is asking, what factor influences the change in the price of stock? Mohammed would like to know the factor that influences the change in the price of stock.
Well, if he listened carefully, we shared some of the things that influence the prices of stocks. But I'll just repeat a few. One of them is simply a demand and supply factor. So remember I said the market is just like any market, and the things that determine prices of any good in any market is not very different from the stock market. So if you go into a stock market and there is a large demand for the stock, then you notice that means there is a demand that is higher, probably more than even the supply. The supply is the number of shares available to sell. The demand is the number of people who are willing to buy. And at any time T, when the demand is greater than the supply, prices don't have any direction other than to go up. If the inverse happens, when you see there's a lot of people who want to sell out their shares, either to make up the gains or maybe they are tired of holding that stock because not doing well, then you notice that the supply for the stocks is more than the demand for, so price will go down. Beyond this, a number of other things can happen. Sometimes market turbulences, sometimes market corrections, sometimes economic challenges, for example, like the pandemic. Sometimes the fundamentals of the organization itself, it may not be doing well, and other things that you check in the 5 things we shared in this training. These can all determine how a price goes up or down for every stock on the market.
Emmanuel Brefo is asking, is there an opportunity to trade other countries' stocks that is not listed in Ghana's stock exchange?
There is. And there are a number of international trading platforms that give you the opportunity to deal with international brokerage companies. And it even gives you access to the trading platform, and you are able to make an order of a buy or sell or bid or ask. So yes, there is. But like I said, because this industry is quite technical, it's always important to understand the basics before you jump into just making a trade order.
Kofi Nyako would like to know, how does a company listing for the first time decide how many shares to offer when listing for the first time on exchange? That's coming from Kofi Nyako.
Well, so that decision usually is part of your trading your listing requirements. So we call something a sponsoring broker. before you list on the market, you go through a sponsoring broker who will guide you and walk you through the rules of listing. And the rules of listing will do some assessment and will be able to tell and value your balance sheet and your books and things, and will be able to come up with a price per share. And when it is valid, that is when we say these are the number of shares you are offering for sale based on the percentage of stock or shares you want to offload. And then when that is done, we list that particular at a particular price per share.
Okay, so please, as your questions are being answered, let us know if you are okay or if you need further clarification. You could use the chat to do that. Someone would like to know, Doctor, what does stock index or indices indicate for investors?
Well, so in an index usually is like a measuring tool that is able to give you an idea about how the market is, the direction the market is going. So the number of indices for number of stocks, and each index is able to tell you what exactly it is measuring. So the indices are used to measure specific things about each market, and based on the market and the index, it's able to tell you that, okay, the composite index is doing this, or this particular index is doing that. And when you know, you are able to tell what every market looks like. Like I said, in our next step, in our next immunity session, when we go into the second part of understanding stock trading, we'll probably be going into the details of, for example, stock selection, understanding it, what it means, the details of even for companies, MSMEs, based on where you want to list, the listing requirements and things like that, among other things. But foundationally, if you don't get what we shared today, you will not be able to progress to the next level.
And we have examples of good brokers in Ghana. That's coming from Office Marks.
Okay, so this is what I will teach you to do. Anytime you are looking for a good industry player in whatever you want to do in the financial services universe, you ask yourself two questions. Is there a regulator in that industry? That is one. Is there a market for that industry? That is two. So if there is a regulator, then the regulator issues licenses that tells you who has the right to do that transaction. Then if there is a market, which is the second question, you are able to ask the regulator and even industry about who has the longest record in terms of success, execution, integrity, among other things. It doesn't matter which industry it is, as long as in the financial service sector, if you get these two things right all the time, you would reduce your risk of exposure and losing your funds. So let me narrow it down to this particular example. You want to, for example, see a brokerage company. The first question you ask is there a regulator? Yes. Who is the regulator? Securities and Exchange Commission. You pick your phone, you go to your internet, you check Securities and Exchange Commission list of licensed brokers in Ghana. They will all come. Then you pick the list, and then you, if there a market, yes, there's a market. You begin to genuinely ask the regulator and other people, which group of people are the top example, top 5 leaders, industry leaders. And in each industry which is regulated, you have categories of players. You have category 1, category 2, category 3, or bands or quadrants, so that you can pick those that fall in the first quadrant. Do your own hands-on research about them. Check their history. Check the people behind those companies. Check how far they have stayed and done the transaction they have done. And it gives you a clue as to who you should do business with, rather than just to say, oh, my brother said these people are very good and you go with them. My sister said these people are very good and you go with them. When you do that, you will burn your hands.
Okay, thank you very much, Doctor. Kafui would like to know how different is the stock market from forex trading markets?
I think I've explained that already. Just as the name, the Forex is foreign exchange, so it's currency trading. Stock is equity, is part of the financial services market. And assuming even the currency market trading was regulated, example, you notice that that one is like in the money market. When we started, the first slide we showed, if my sister was watching, let me go back to that slide. You will see that we talked about the financial markets, and the stock market falls under the capital markets, and the currency markets falls under the money markets. Just that I'm saying that before you take into interest into any of them, whether it's for forex or stock, make sure that there's regulation and there's a market industry. So that's the distinction between the forex and then the stock.
Okay, so I'm going to Facebook to pick some questions from there. So Bakari Yusuf is asking how they are going to get the boxes. That's the CYP challenge, how he could get the boxes.
All right. So what you do is that you need to sign up to that challenge, because we are going to be very disciplined. We are going to be very hard on people, not to just say, I want to count your penny box, and then you go to sleep the next moment. So you have to, there is an online application you will do to just say, I'm interested in the challenge. You fill that detail. Then we'll give you an onboarding kind of form where you commit to say, when we give you that box, you won't tamper with it, because when you tamper with it, you are disqualified. When we give you that box and you take the category you belong, you will commit to it either daily, weekly, or bi-weekly. And you must put money into your own box sealed for that duration, so that by the time the challenge is over, when we come round and open your box, you will be able to raise a minimum of 6 months of your regular income that can be invested in any of the markets we are training you into with your investigation. So to start with, first and foremost, you have to make a request to a link that I'm sure Julia will be able to share. So those who are interested, you can fill and apply. And when you apply, they will reach out to you. You get the onboarding form. You even be taken into what we call a risk assessment form to understand your level of appreciation with putting money aside in your own savings box, and the kind of investments you'll be interested in, or your understanding of the financial service, among other things. And maybe your commitment as to, will you be able to put 1 CD into your own box that sits with you, not with anybody, for say the next 10 months, and do it consistently. So we can assign a financial literacy consultant to you that will become your help and your friend. We'll be just checking on you as much as we can. And wherever you are in the country, when the time is over, if you are part of the community we are raising, we will come to you and we open the box together. Make sure you didn't tamper with it. And if you have been able to raise that minimum for your financial immunity, you get opportunity for our partners, either the investment banks, or the insurance companies, or the pension companies, will now walk you into taking a product that can give you great investment outcome, so that you are part of the financially independent group of people we are raising across Ghana and the rest of the continent. So first, Julia will share the link, and when she does, either on Facebook or on the Financial Immunity Community platform, or even on Zoom, those of you who are in studio on Facebook, make sure you get it and you like it. Thank you.
Okay, so I've shared the link on the Financial Immunity Community page. It would be shared as well on the Facebook page. I would shortly put it in the chat so that we could get access to the forms to apply. Albert Brony is asking, how does a partnership between two stock markets in different regions or countries work? For example, the Ghana and the London Stock Exchange partnership.
Maybe if Albert can explain what kind of partnership especially, it will be helpful.
Okay, so Albert will be waiting on you. Could you just further explain it in the chat, then I'll pick it up. Enigma would like to know, please forgive me if I didn't mention the name well. Please, how do investors do immediately take out their shares or stocks out of the company before the company falls into a loss? I've heard a lot of true stories where investors take their shares out as soon as possible.
All right, so say when the stock is listed, on the market, one of the good things you do is when you want to sell the stock, you if you have access to the trading platform, you make a sale order. If you don't, your broker is there. You have to call your broker and say, I want to sell these stocks. And usually for every good brokerage company, they will be able to sell for you in good time. and then you can take your money and move on. But let me say that selling of stocks doesn't, it is not like selling of mutual funds. We'll get into understanding mutual fund. Selling of mutual funds usually is easier because it's a duration, maybe 5 days, 3 days, whether it's bought or not, you get it. But selling of stock, you must always get a buyer before it is sold. So even when you had given the order to your brokerage company or to your broker to make a sale, usually it doesn't simply mean it is sold the next day. If we get a buyer the next day, great. If we don't get a buyer, we'll wait till we get a buyer who is willing to buy at the price you are giving, or maybe at a discounted price.
Okay, thank you very much. Please, as I said, if the answer to your question was not clear, please just expatiate on it in the chat and we'll pick it from there. Felix Ajiman. So is there a broker for each company on the market, and who pays the broker?
That's a good question. So yes, there is always a broker. There are trading charges, and so usually your broker, as part of the services they render, just like any other service, there are service charges that come with the transaction. So for example, if you are buying a stock and maybe it is costing you 10 cedis to buy, there would always be some charges in there that will be taken out of the transaction. But it is usually very insignificant.
Okay. So Enigma is asking again, how is it done? How do they know that this company is going to go into liability? So this is a follow-up to his question earlier on how people are able to quickly get to sell their shares before a company falls into a loss. So I think this is a follow-up on that.
Well, let me say that if you remember some of the things we shared, if you remember, and let me go to the slide that speaks to it. If you look at this slide, for example, one of the things we spoke about was that you should monitor your portfolio all the time. So anytime you make a purchase of a stock, you don't go to bed. Many people have bought shares, they don't even know where the shares are as I speak. Many people have bought shares, they have never checked whether they have paid dividends or not. In fact, for some people, they have even paid dividends, but they can't find the dividend warrants they paid. They can't even trace it in their bank account. For many people, they don't even have a CSD account. They bought shares and they were giving certificates many years ago. They don't even know that now shares are immobilized into a CSD account and that we don't use paper certificates anymore. So monitor and engage with your broker and take part in educational sessions like this all the time, and use the things we shared in monitoring some of the things we'll be sharing. Always check how the company is doing. Look at their annual reports to check how they are returning profits. Look at a number of things all the time. Because if you want to make money, look at the people who are making money. I shared with you the portfolio of, say, somebody like Warren Buffett, and you don't have to go and sleep. Look at all these companies. Apple, Wells Fargo, American Express, US Bank Corp, all these one, Goldman Sachs, he has shares in them. You have to be interested because you are an owner. You are an owner. And as an owner, you must be interested in what is happening there so that you even have an idea whether it's going up or down.
Okay. Thank you, Doctor. So I'm going back to Facebook to pick a question from Emmanuel Obin Perquason. So Emmanuel is saying that even though he joined in a little late, he wants to find out, he started with shares in the 90s, but he burns his fingers in these transactions. He sold his shares recently, but some still remain unsold. It has eroded any interest. Has it eroded any interest? That's what Emmanuel would like to find out. Has it eroded any interest?
I don't understand that question, but what I'll say is that if he bought stocks long ago and they didn't do well and so his interest is gone, it's a good experience, even though it doesn't sound interesting. But usually you can end up like that when you just buy the stocks based on hearsay or based on a TV advert or based on maybe a friend recommending to you, and not based on a certain understanding like we are sharing, so that even when you get a broker or a licensed advisor, you don't leave every decision of what stock to buy, when to buy to him, and you wait for him to tell you when to sell or not. You should have an appreciation yourself. And if you can apply these things we have shared, you'll be amazed that you will know when to buy, how to buy, when to sell, among other things. Now, for the ones you have bought that didn't do well, if they are still standing, if they are still there, and the companies are still listed, do the background checks we said you should do on every stock. And if you do them and you engage your broker and the fundamentals are still right, hold, hold, hold. You don't always have to sell, hold. If they are not right, the fundamentals are not right, the market indices and the PE ratios and the things are still not right, sell off. Cut your losses. And you do that transaction through your broker when you give a limit order and say, sell at this price. Then you sell off. Then you can come back, do analysis, and buy very good stocks.
Okay. So, Emmanuel, I'll just ask you to come back again. If your question has not been answered, please come back again and we'll pick it up for you. So let me, Asan is asking, what level of financial knowledge do you need before trading in stocks?
I think we've shared the level of financial knowledge you need to know. You cannot be an expert. That's why you need a broker to guide you. But you must have some basic appreciation of the markets. One of them is this. You must know that when you want to buy a stock is a product or an instrument in the capital market. That capital market, the financial markets, that understanding must be there. You must understand what a stock is. You must understand the market itself, the structure of the market, the regulatory, the regulator, how the trading is done. You must understand some of the terms that when you are speaking to your broker and he's mentioning some of them, you appreciate it more. You must even understand the 5 essentials you need to know about every stock so that you have first-hand knowledge yourself. You must appreciate it. So it guides you, because sometimes you have in mind that you have some money, you want to put it away for 3 months, but you don't know that in 3 months, you can't go into a capital market that is long term. You hear somebody say, oh, this stock is good. You just go and put your 3 months money into a market that is long term, beyond a year, sometimes 5 years. And without that knowledge, it doesn't matter who told you to buy, you may burn your fingers. So basic understanding is what we have shared. And if you can go back, watch this video, become part of the financial immunity community and join as much as possible all the financial literacy things we'll be doing with all the partners in the industry, so you can become a master of the markets, either under banking, under pensions, under insurance, or under investments, so you can take your own financial future into your hands. Thank you.
Okay, thank you. There is a question coming from Atukwame Esiam on Facebook, but it's not so complete. He's saying that there are fixed investments which promise fixed rate of returns. That is known rate of returns. Doc, please, would you say stock market is better than money market, taking into consideration the risks associated with investments?
Well, I want to say something. We taught this last time, but I'll say it again. If you read last week Monday's Business and Financial Times, for those of you in Ghana, we shared a piece on 7 golden rules that you can apply to have a good investment plan. And in that paper, of course, tomorrow we will be sharing another thing about mutual funds in the Business and Financial Times. And if you listen to, if you watch DSTV and GoTV, we have a program there called Money Lab. We would also be sharing some tips on how to take a good investment decision, among other things. But for the decision as to this particular question, you must always have an investment objective. Your investment objective and the investment duration is what will tell you as to what product to even buy. If your investment objective is long term, you come into the capital markets, as I've shared it here. Capital markets are long term. If your investment objective is short term, a year or less, you come into the money market. If you are not too sure and you stand in between, you leverage on mutual funds, particularly balanced funds. And you can be guided. You can go to any of the investment banks, and when you ask about these, they will guide you. But always, the decision to buy what product depends on investment objective, your investment duration, and your risk return profile. For somebody, when he makes an investment purchase and the next moment he loses 1 cedi, he can't sleep. It means your risk return is very high. For another person, if he puts another money there and he loses all, but he knows that until the duration is over, he can still recover and he doesn't panic, it means his risk return is high and his risk appetite is high. So your objective for investing, the duration when you need the money back, and your risk return profile, 3 things among others, are so important to tell what investment product you decide on.
Okay. So let me come back to Zoom. Hassan again is saying that GSC is said not to be too liquid. How true is that? And is it advisable to trade?
That is too I don't want to say pedestrian, but it depends on the stock. There are stocks that are doing very well in terms of liquidity trading. Of course, let me say that trading in stocks doesn't give so much liquidity. You can't buy a stock today and sell tomorrow easily on a market. In some advanced markets, it can't be that easy. In other markets, particularly if they are index funds, in other markets, not necessarily, because you bought into a share of a company. That is a long-term thing you are doing. So you don't expect that you sell immediately and somebody buys. It can happen, but that shouldn't be your motive of just buying a stock.
Okay, Victor Avevo is asking, how much do I need to trade in stocks? 100, 1,000, or 1,000,000?
Well, remember I answered this. And the answer was that to be able to tell, you must ask 2 questions. The first question you must ask is, what is the price per share? The second question you must ask is, what is the minimum number of shares? So when you get a price, you multiply by the minimum number you are required to buy. And if it's within your means, you can. If you have the opportunity to buy more than that, you do, because the more shares you have, the more ownership you have, and your ability to make more either on capital gain or to make more on dividends. Thank you.
Felix is asking, who decides when the dividend will mature? And
well, dividends dividends are paid annually, ideally. But usually your dividend will be dependent on your dividend payment will be dependent on, as I said, the company's dividend policy. So what is a company's dividend policy? Do they pay every year when there's profits, or do they reinvest, or what is it? You must find out about the dividend policy of the company before you ask about dividends and when they are paid.
Okay. Richmond, and he also wanted to know, periodically, do you get access to the financial statements of the firm to ascertain their performance if you can continue to buy more stock?
Oh, yes. The moment a company gets listed on the market, it's a public company. And so they are required by law to publish their financials within certain periods of the year. And even for the Ghana Stock Exchange, they have sessions where each of those companies come to the best the market floor and even explain the fact behind the figures as to what is accounting for the up or down trends. And you can find it, they publish it, and they make it available in their annual reports.
Okay. So Felix wanted to know, so if he understands, the CYP challenge is to give you the seed to sow in the stock markets. Yes. Not necessarily the stock markets, but Doc, please, if you could further explain that.
Okay, so I won't say that the CYP has nothing to do with the stock market. The CYP is about immunity. This is a financial immunity community. And we are putting together a challenge of 1,000 Ghanaians who can raise regular savings for themselves that can produce a minimum of 6 months equivalent of their income. So we give you a box, which is a challenge box, and then you choose whichever the option you want, regular, stretch, premium, and you put in the amount in each of those options. And for option 1, which is regular, you do daily. For option 2, which is stretch, you do weekly. For option 3, which is premium, you do bi-weekly. So example, if I chose a regular, remember it is up to 50 cedis daily. So 1 cedi up to 50 cedis, any amount I can put in between 1 cedi to 50 cedi, it must be daily in that box. For another who chooses stretch, between 51 cedis to 100 cedis, every week, I should be able to put in any amount between 51 cedis to 100 cedis. Same for premium. For every other week, I should be able to put in 101 to 200 cedis in that box. And I do it consistently for the next 10 months without touching the box. And when it is due, we'll come back with our financial literacy consultant and we'll make you know how much you're worth. Now, immediately you choose the option, we'll be able to tell you how much you are likely to earn, as in raise yourself with the deposit you put in the box. And we'll do some analysis with you, and you'll be able to know where you put it with our partners. You know, we have pension, we have investment, we have insurance, we have banking. The partners that we would bring on board will be able to give you a variety of products. You can put some of them in. And the people who do well stick to the challenge and are able to do very well with their pennies. They will even get gift vouchers that are money inclined that will add up to whatever they raise to become startup investments or startup any kind of financial instrument they would want to buy. But ultimately, the aim is to raise the next batch of young millionaires who are turning very little money, 100 cedis, 10 cedis, 5 cedis, 50 cedis, 20 cedis, into a daily, weekly, bi-weekly habit, behavior, and over some time, they can have some good amount of money that can take care of their daily needs.
Okay, I hope that answers you well. Abdul Razak would like to find out, is it advisable to buy a share at this time of the pandemic?
Well, remember that you practicalize what we have learned. You don't just say yes or no. You check all the things we said you should check before you buy a stock. So go back and check the things we said before you make a purchase to buy a decision to purchase a stock. Check all these things, at least 5. Check them and see. Usually in pandemics, companies don't do well, stock markets stumble, so prices fall. If you get to the market and you check the company's fundamentals and they are still right and the price are falling because of the economic challenge, buy, because the markets is down, it is bearish. And when it is bearish, as long as the fundamentals of the companies are right, you are good to buy more, so that when the market becomes bullish, you sell out.
Okay. Abdul Karim would also like to know what's the difference between stock trading and investing. I think this question has been answered in many ways, but Doctor, would you like to still touch on it? What's the difference between stock trading and investing?
Investing is generally putting your money into an instrument or an enterprise with the aim of expecting a return over a period. Stock market trading is simply going into the capital market, if it's a listed market, to buy ownership in a company that has listed on the stock market so that you can make some returns as an owner in the organization.
Okay. Adrian Jamal would like to know, would you send us the PowerPoints? Edward would like to know whether he would have the PowerPoints for this presentation.
Thankfully, because it's on Facebook, you can always go back and check. But let me say 2 things. Because of our time is up. We have to, we have another immunity session in Zambia, and so we would have to close. But you can always get a package of the slides and the certificates from the Ghana country team. And you can call the Ghana country team on 0544. Julia, what is it? 200, 500?
Yes, please.
200, 500. You can call them and they can help you out. They have a platform where they share tips and bits and pieces here. You can join that. You can go back to Facebook and watch everything that we projected and have access to same. Or go to the YouTube channel where we will load this up. And you go to YouTube, you type Richmond Kwame Frimpong, or you type RKFI Coaching. Richmond Kwame Frimpong, subscribe to it, and you have access to this so you can watch and listen at your own time. But most importantly, don't miss the conversation Axis told you about. Reach out to them. Don't miss the opportunity to join the challenge, the Count Your Pennies challenge. Don't miss it. Don't miss it. You are getting the opportunity to be coached, to be guided, to discipline yourself, to put money in your own savings box. That will be open within 10 months, and that will make you a rich person. So don't miss that opportunity also. And don't miss the opportunity of being part of the financial immunity community. So you can invite us to your company to talk to you, invite us to your church to talk to you, invite us to wherever people gather and they want to have financial literacy. So we can educate you on what to do. Thank you very much, and God bless you.
Okay, thank you very much, Doctor. We are very grateful for this insightful presentation. The feedback from people on the presentation has been massive. And we are encouraging you that you just don't stay at this level, but go further by taking action with this, what you've heard here. So Doctor has shared with us all the various actions we need to take, reaching out to others, getting your CYP challenge, filling the form and getting on board, joining the financial immunity community. There are a lot of actions we need to take. You can just start from where you are. You can just start from where you are. So let's take note of that. I have shared the link in the chat for the CYP challenge. I've also shared the contact. So please, if your question was not answered, please put it on the page. Put it on the financial immunity community page. We will reach out to you, or call the call center number, that's the 0544 200 500, and we would answer you. So thank you all for your time. Thank you all for registering to be here. We are grateful for all of you, and we want to further appreciate the FLF Africa Ghana team that was able to put together this program. We appreciate you all, the country office team, the regional coordinators, the team coordinators. We appreciate you all for every effort you put into invite people to this program. We are grateful. Thank you all for your time. So this brings us to the end of our session. Thank you.